Hey YouTube, welcome back to My Financial Focus. In this video, I want to talk about Zoom Technologies, which is essentially a business that a lot of us have become very familiar with over the last few years during the global pandemic. And essentially what Zoom does is they connect people with secure face-to-face video and make it easier for people to communicate remotely. They have a variety of different products, as we can see right here. They have their Zoom Meetings products, as well as some more focused products like Zoom Education, Finance, Government, and Healthcare. And as we can see from their plans and pricing models, their business model is primarily a free model, so they offer a free model for their customers to buy into to get basic functionalities for their platform, but the free model only has a 40-minute limit, so people aren't able to stay in a meeting for more than 40 minutes, which incentivizes people to step up to the pro, business, and enterprise models, which they sell on a subscription-based business model. And these different models basically provide greater and more concentrated functionalities. And basically how Zoom works is someone looking at this might think that they wouldn't have much cost of revenue since they're selling a subscription service that basically just allows people to meet up virtually and from home. But the fact of the matter is that the cost of revenue for Zoom primarily stems from hosting their platform, as well as paying for data centers and third-party cloud hosting, which is something that they had to do a lot of during the global pandemic because they were not able to keep up with the demand for their product during the global shutdown. So the next thing that I want to do is go into their annual report and just go over a couple of the risks that are facing Zoom. And that starts on page 8. So in business and in the stock market, there are two kinds of risks. There are the black swan events, which are essentially the events that nobody could ever have predicted would have shown up and that have pretty grand impacts on the overall market. And then there are the problems like the gray rhino problems, which are essentially problems that are massive, that people know are there, but that people tend not to really focus on until it's coming at them at full speed. And in the case of Zoom, they are definitely facing a gray rhino problem because of the fact that the global pandemic, as we can see from the second bullet point, had a pretty substantial impact on their revenues. When everybody was locked down at home and they had to continue working from home, Zoom was the main product that they all went to. And so because of that, Zoom experienced an enlarged impact on their growth rate. And the second risk that comes with Zoom is obviously the fact that Zoom is still a new company. So because they have limited operating history, it's a little bit difficult to anticipate what the future outlook for Zoom's business will be because they just don't have enough experience to come to a certain conclusion. So the next thing that I want to do is look at their financial statements, and this is going to give us a good understanding of the financial health of the business, which we can then use later on to do a discounted cash flows analysis of the business after I'm done looking at the financials. So right here, we can see their income statement, and we can see that over the last couple of years from 2017 to 2021, their business has pretty much exploded from revenues in 2017 of about $60 million to now in 2021 of $2.6 billion. And their gross profit has grown at about the same rate from 48 million up to $1.8 billion in 2021 from 2017. And their net income is finally profitable. They turned a profit in 2019, but because of, as we can see right here, the section titled Undistributed Earnings Attributable to Participating Securities, they actually broke even in 2019, ending up with a net income of exactly zero. And it was only in 2020 that they were able to start retaining some of the earnings that they were bringing in from their business. And in the first 2 years, 2017 and 2018, they were operating at a total loss. And then 2021, obviously, because of the global pandemic, the year ending January 31st, 2021, they experienced a pretty substantial increase to their net income right here of $671 million. The next thing that I want to look at is page 55. And in page 55, it basically gives us a breakdown of the revenues and cost of revenues by percentage. We can see that from 2019 to 2021, I know right here it says 2020, but this really means the year ending January 31st, 2020. So this is actually the year of 2019, and this is the year of 2020. And so for 2020, that was the first year when the shutdown was implemented. Zoom experienced a 326% increase in their revenues from $620 million to $2.6 billion. And the cost of revenue for Zoom over those years also increased by about 612%, with their gross profit margin decreasing from 81% down to 69%. And that primarily came because of the fact that they weren't able to keep up with the demand for their product in 2020. And so they ended up having to spend a lot of money on third-party cloud hosting solutions, which are a lot more expensive than if they were hosting their own platform in-house. And because their cost of revenue increased faster than their actual revenues did, they ended up experiencing a negative impact on their gross profit margin. So the next thing that I want to look at is page 67. And this is their balance sheet, which basically gives us a snapshot of the business's financials at the end of the year on January 31st, 2021. And as of January 31st, 2021, they had total assets of $5.2 billion, which is up from $1.2 billion at the end of 2019. And then also their total stockholders' equity came out to $3.8 billion, which is a substantial increase from $800 million the year prior. And we can see that they have been able to retain a much larger portion of their earnings, up from only $150,000 in January 31st, 2020 to $670 million in January 31st, 2021. So that's a pretty good sign for a business. But like I said before, Zoom is facing a gray rhino problem in that it's not certain whether or not they'll be able to maintain these very explosive growth rates in the future when people start returning to the office and start depending less on working remotely from home. The next page gives us a glimpse at their income statement, which we had a glimpse of earlier, and we can see right here that the net income attributable to stockholders, like I said before, came out to zero in 2019, but they were definitely able to increase that over the years. We can see that the earnings per share has also been increasing, and also the amount of shares on the market for Zoom have been increasing from about 84 billion to 283 billion. And lastly, I'm going to go to page 71, which shows us their statement of cash flows, basically giving us a good idea of the cash that's flowing in and out of the business. And this, of course, doesn't take into account the expenses like depreciation and amortization that are not cash expenses. So those are added back to the net income amount to give us the cash amount that the business is actually producing. And we can see that that's increased quite a bit as well, from $51 million in 2018 up to $1.4 billion in 2020. They've been investing pretty heavily in marketable securities. As we can see right here, they invested $2 billion in marketable securities in 2020. And from financing activities, they raised about $2 billion from a public offering. And so the increase in cash for 2020 was $1.9 billion, and they ended the year with $2.2 billion of cash, up from $300 million in 2019. Next page that I'm going to look at is page 80. And in page 80, this basically gives us their revenue broken down by geography. And we can see right here that 69% of their revenues in 2020 came from America, which has been steadily declining from 2018 to 2020. And in my opinion, this could be interpreted as either a benefit or a loss, depending on someone's perspective. But in terms of the perspective of revenue diversification, it's definitely a benefit because Zoom is pulling their revenues in from multiple different countries and nations internationally, as opposed to just focusing primarily on revenue coming from the American region. Next, I want to look at page 82, and we can see right here, this is a breakdown of their marketable securities. And so we saw earlier on their cash flow statement that they were investing heavily in marketable securities. And I just thought it was a little interesting to see what it was that was actually being considered in that monetary amount on their cash flow statement. And we can see right here, their financial assets are money market funds, treasury bills, and that comes out to about 1.5 billion. And then the marketable securities are like commercial paper and government securities and agency bonds, which they're basically holding as a way of collecting interest on their cash as opposed to just letting it sit in the bank and collect dust and lose value to inflation. And the last page that I'm going to look at before we do the discounted cash flows analysis is this revenue chart that basically breaks down their revenues and their profits by quarter over the last 2 years. And it's interesting to see that their revenues have been steadily increasing each individual quarter from 120, I believe this is $120 million in April 30th of 2019, and that's up to $800 million in January 31st of 2021. And so I'm not sure if they're going to be able to maintain this growth rate going forward, but it's interesting to see that in the past, up to this point, they've definitely been increasing their revenues at a pretty steady rate. So now I'm going to do the discounted cash flows analysis so we can figure out what a good buying price would be for us as value investors if we wanted to buy into Zoom Technology stock. Currently it's trading at $184 per share. And we're going to figure out if that's a good price to buy into Zoom based on the business's current cash flows. So what I'm going to do now is get their growth rates from Yahoo Finance, which I've already gone ahead and done. We can see from Yahoo Finance the growth rate, if we scroll down here in the analysis tab, comes out to be 13.58%. And for the growth rate for years 6 through 10, as we saw before, we're not sure if they're going to be able to maintain the explosive growth rates that they've had in the past. So I'm just going to cut this value in half at 7%. And for the year one free cash flow, I took this value from TradingView. I just went to the cash flow section for Zoom, and then right here we can see that for 2020 their free cash flow came out to be $1.4 billion. For their net cash minus net debt, I got that from Yahoo Finance in the statistics tab. By just scrolling down, looking at their balance sheet, we can see they have a pretty good ratio of cash to debt with $5.42 billion in cash, and their total debt comes out to only $97 million. So that's definitely a very good ratio. Stock ticker is ZM, and then for the shares outstanding, we can see that right here, 242.24 million shares. So basically what this cash flows intrinsic value calculator is showing us is right here, this is the free cash flow that they theoretically will be producing in year 1, year 2, all the way through to year 10, based on the growth rates for years 1 through 5 and years 6 through 10. And we're just discounting these cash flows back by our discount rate of 10%, which basically says that if we invested this amount today, 1 year from now, we would get this. And if we invested $1.3 billion today, then 2 years from now, we would get 1.5. And so it just does that for each individual year. And right here, we can see that if we invested $1.25 billion today, then 10 years from now, we would have $3.26 billion, which is a free cash flow, if we had a 10% return per year. And then the terminal value is just it's basically a theoretical value that says if we were to sell the business in year 10, we would sell the business for a value of 10 times our free cash flow at that point. And so to calculate the present value of all of the future cash flows, we just add all of these values together, which gives us 26 billion, plus the amount of cash that's currently already on the business, which is about 5.32 billion. And then we divide the intrinsic value in billions by the amount of shares outstanding, which gives us the intrinsic value per share of $129.52 per share based on these growth rates. And so relative to the stock's current share price of $184 per share, it would seem that Zoom is currently a little bit overvalued. But if we were to increase the growth rate to 13.58 and just say that from years 1 through 10, the growth rate were to remain steady, that intrinsic value per share increases to $153 per share, which still puts Zoom at an overvaluation. So keep in mind that a discounted cash flows analysis is not fully comprehensive. It's not a perfect model, but it is a tool that we can use when trying to figure out the intrinsic value of a business. And in this case, if we wanted to make a smart decision as value investors and buy into the stock with a margin of safety, like someone like Warren Buffett or Charlie Munger or Peter Lynch would do, then we would want to buy into the stock at about $100 to $76 per share. And at the moment, Zoom is trading at $184 per share. It's down quite a bit over the last month, and down even more over the last 3 months, and even more over the last year. And we can see that when it listed in April 18th, 2019, it was trading at $36. And since then, even with the decline from their all-time highs of about $559 per share, they're still up about $411.62%. So it's still a pretty good return for people who got into the stock earlier on, but certainly not as much as it was a little bit ago, like a year ago. And according to the discounted cash flows analysis, Zoom is currently still overvalued at the current price. But I'd love to know what everyone who's watching the video thinks about Zoom. Is it a buy right now, a sell, a hold? Definitely let me know in the comment section below. And if this video provided any value, be sure to leave a like. It helps the algorithm. It helps this video get noticed to more people on YouTube who are interested in financial business intrinsic value analysis like this. Subscribe to the channel if you haven't already, and I'll see everyone in the next video.